Namaste to all. I welcome you all to this another knowledge sharing series, another webinar by our own accounting standard board. And today, the topic, because we are nearing the financial year end, 31st March. So very apt topic kept by the board. That is the key accounting considerations for the preparation and presentation of the financial statements for the financial year 23-24. And to discuss this topic, we have got two stalwarts, both and well-known faculties. We have got CA Praveen Kumarji, who has been contributing to a great extent because he is a regular faculty also on the Ind AS certificate course. But whether it is AS or Ind AS, and even financial statements and audit, he has been always there to support all the members and the ICI. I welcome you, Praveen Kumarji, and thank you for joining to share your views on the subject. Again, we also have our star speaker and faculty, CA Archana Bhutani, who has been very regularly contributing on the matters of AS and the Ind AS, regularly contributing to the accounting standard board as well as EAC earlier, and has been a speaker of umpteen number of times. I cannot say number of times, but yes, I welcome you and thank you, Archana Bhutani, for joining as a panelist out here. Thank you very much. And to moderate these two stalwarts, we have none other than Asha K. Sharma, who has been she's a convener of one of the study circles, prominent study circles in Delhi, and of course her knowledge is really too great, and she is a keen learner of not only other than the taxation, the accounting field and other. So all floor is yours, Asha, to take these two stalwarts again, and I'm hoping that today's session would be very fruitful. And again, to the members, this video, because I've received various messages that if they are not able to view it live, then where to view. Of course, you can go to ICAI TV. It would always be there. Apart from that, even on the ICAI YouTube channel, you can see it anytime, because later on, sometimes you want to re-clarify certain points which are discussed today. So you can again go back and view all the ASB webinars you can see. Thank you, everyone. The floor is with Asha. Asha, please take over.
Thank you. Thank you so much, sir. So, namaste and a very good evening to everyone. At the outset, I would like to thank Accounting Standard Board of ICAI, its Chairman Pramod Jain, sir, Vice Chairman Abhay Chadar, sir, and its entire team of ASB for giving me this opportunity. And of course, it's my privilege to moderate this session on key accounting consideration for financial statement preparation and finalization with our expert and eminent panelist Archana ma'am and Praveen sir. And as said, like Chairman sir, ki questions के answer थोड़े short रखेंगे. तो definitely sir, I will try कि मैं questions को भी थोड़ा speed up में रख सकूं सामने. So, see, preparation of financial statement properly is very important, and as we all know that financial statement are face of any business, which is inevitably very useful for many of the stakeholders of businesses, be it present client or the prospective client, various stakeholders and government departments, regulatory, revenue departments, and so on. And basically it provides a comprehensive view of the entity's financial health, overall performance and all. So, and another thing which we also know that financial statement is prepared on the basis of trial balance, and trial balance need to be readjusted for various kinds of things like accrual concept, matching concept, or various other decisions which is to be taken at the year end. So it's very important to understand what are the key things which need to be considered at the time of preparation and finalization of financial statement. And as said by Pramod sir also, like Accounting Standard Board, in its endeavor to enhance the knowledge of members and stakeholders, regularly conducting webinars and various training workshops and courses also. And I must say, sir, timing of this webinar is very appropriate as we are setting on 26th of March and it's closing of the year. for our audience, there are many issues which need special attention while preparing and finalization. But if we go on to discuss all the things, then of course, one full day will be short of time, and we have been allotted only 2 hours. So we have tried to design the questionnaire in such a way that all the peculiar issues get covered. And of course, this will be explained by our learned panelists today. And I would request our audience to post their queries uh, while watching this webinar, and we will definitely try to cover all the queries also. And before we start with the questions, my request with the panelists today, please respond to your queries on the basis of this with respect to accounting standard also, because we all know that the percentage of accounting standard compliant entities are much more than as compared to the Ind AS compliant companies. So with this, we will start our technical session today with the permission of our both the panelists. May I start with the question?
Yeah, please.
Okay, sir. My first question is from you, sir. Can an entity have different financial year other than the 1st April to 31st March? Like, for example, in case of corporate entity, a company is incorporated on 15th of January. So is it required to prepare its financial statement from 15th of January to 31st March and get it audited also under the Companies Act? And also, please elaborate on non-corporate entity side also, sir. Please.
Yeah, thank you so much. My gratitude to Pramod sir and for giving another opportunity to interact and share the dais with him. It is always a privilege when Pramod ji is speaking, then you always learn a lot of new things, and you come to know about the practical issues. And I think this webinar is designed in such a manner. Before we came on to this webinar, both Archana and myself, we were discussing that these are very, very practical issues which are being planned. So really, thank you so much, Pramod ji, for making it happen. And also, thank you, Asha, for all the hard work which you have done to make it, in a very, to ask us very difficult questions so that we should also come prepared. So, but as I do in all the, webinars and wherever I go and speak, first of all, I give a disclaimer that and this is for all our professional colleagues, that whatever we are saying, we are sharing our individual thoughts, individual opinions. From any stretch of imagination, please do not take these opinions or these views as views of the institute or the Accounting Standard Board. When you are in a situation and you have to take a call, please go through the literature, do your own homework, prepare your own audit work paper, and then take the calls. Many times the views can be different from people to people. So these webinars, and Pramodji, please correct me if I am wrong, are primarily to, provoke the thought process and give idea, and give direction to the people that, okay, this is also one perspective which you can look at when you are looking at, these particular issues. So, Pramodji, would you like to, say a few words on this particular aspect? Because many times I heard people saying that, oh, in that seminar, that person has said, that is why we took this call.
Oh, very, very rightly said, Praveenji, because these are all views. In fact, I'll like to tell to all the members, sometimes what happens, certain issues come to the Accounting Standard Board. And what happens that in order to arrive at a solution to that, some say myself as the chairman or vice chairman or the office might be thinking in a particular way, but we cannot give that solution unless it is approved by the board. Board, when we go to the board, there are so intelligent persons out there, the thought process changes, and then you see, okay, this is the other way. So whatever is said currently in all the webinars, I'm telling all the webinars, not only ASB, all others, it is not the rule, because for a rule, it need to go through a process. So very rightly disclaimed, Praveenji. one should take a call accordingly. Thank you.
Yes, thank you so much. And now I'm coming to the question about those financial statements. So if you look at section 2 and subsection 41, clause 41 of the Companies Act. So financial year in relation to any company or body corporate means the period ending on 31st day of March every year, and where it has been incorporated on or after first day of January in a year. That means anytime after 1st of January, then the period ending on the 31st day of March of the next year. So provided that where a company or body corporate which is holding company or a subsidiary or associate of a company which is incorporated outside India and is required to follow a different financial year for consolidation of its accounts outside India, the central government may, on an application made by the company or body corporate, in such form and manner as may be prescribed, allow any period as its financial year, whether or not that period is a year. So, according to the Companies Act, and this applies for the Income Tax Act also, applies for non-corporate entities also, the financial year remains April to March in India. This is Indian regulations, whether it is company law or Income Tax Act or other regulations. However, in case the company wants to have a different year, then they have to go to the central government. In the same breath, if there is a company which needs to have a different financial year, they can take an approval from the central government. So that probably answers your question that financial year is April to March. And in case it is after January, then in the Companies Act for the first financial year, 15 months is allowed. So you will have 31st March of the next year as the first closing. Yeah.
Thank you, sir. One thing
here I would like to, sorry, Asha,
yes,
I'd like to add.
Yes, sir. Yes, sir.
The reason why Praveenji, Archanaji, this question was kept, that many a time what happens that a company is incorporated, say on 1st of February 2024, for example. Now, what is done that because under income tax, we'll have to file the income tax return from 1st of February to 31st March. So financial statements are prepared and the income tax return is filed. But many a time what happens that professionals get those financial statements prepared for these 2 months under the Companies Act and get them audited also, which is legally not allowed. Legally not allowed. So here, if a company is incorporated, as you said, after 1st of January, then as per the Companies Act, the financial year would end only 31st March 2025, not 2024. So there would be no financial statements finalization for 31st March ending 31st March 2024. So one has to be very, very clear out here. One has to be very, very clear that under the Companies Act for the next year, it would be a 14 months financial statement. But income tax, it would be again a 12 month. So different financial statements would have to be prepared under Companies Act single, under income tax two separate for 2 separate years. So this has to be kept in mind, and it is mandatory. It's not optional. Not optional. I prepare. No, you cannot prepare as per the Companies Act. So that's why. Thank you.
Yeah, thank you so much. And this 2 months or 3 months financial statements, which will be prepared for the purpose of finalizing or submitting the tax return, this will be under special purpose framework, not as per the Companies Act.
Thank you, sir, for clarifying. And one thing I want to say, Praveen sir, that these questions are not prepared by me only. It's a team effort. So with that, my second question to Archana ma'am. Ma'am, how many types of AS are applicable in India, and who has to apply which standard? Like, is there any category or level of entity or any exemption to someone? Like, yes, please, ma'am.
Okay, I think I thought we were going to keep the answer short, so I'm not going to get into level of exemptions because that will get very technical.
Yes.
And there are very different kind of exemptions under each set of standards. I think, first of all, everyone needs to recognize, I would put it like this, that as far as companies, and unless until your law permits some exemption, all the standards, the frameworks that we have, whether issued by ICI or those which are recommended by ICI and finally notified by MCA, all of them are based on accrual basis of accounting. So if a company or any other legal entity, corporate, non-corporate, is on accrual basis of accounting, then we would obviously expect them to follow these standards. Now, if I was to first look at the corporates, which are under MCA, the companies, if I was to talk about it, there are two sets of standards, accounting standards and Indian accounting standards, which are applicable. And both have their both are based on accrual basis, but both apply to companies meeting specified thresholds. So, for example, for India's, there is a requirement. One of the criteria is 500 crore net worth. Actually, now it is 250, and even that is covered. So, and you can even voluntarily adopt Ind AS. So companies can voluntarily adopt Ind AS. Similarly, as per the Ind AS roadmap, there is a planned roadmap for banks and insurance companies. I'm not getting into that, but I'm just talking about corporates other than banks and insurance. As far as NBFCs are concerned, they're also covered by the Ind AS roadmap. But the only difference between NBFCs and the other companies is that while companies can voluntarily adopt Ind AS, NBFCs can't. So unless and until they're covered by the roadmap, they cannot voluntarily adopt Ind AS or cannot follow Ind AS. Then you've got the other set of financial statements, which is what we called, generally referred to as or casually referred to as Indian GAAP, what we're more comfortable with, which is the accounting standards. Ind AS are converged with IFRS. We have some carve-outs, right? AS are also now slowly being revised. They are to quite an extent closer, but of course, they're much more simpler in that context. So as far as companies are concerned, two sets, AS and Ind AS. Ind AS, if I was to say larger set of companies, what we typically refer to as public interest entities, and AS for the others. Then let's say you've got entities which are not companies, okay? You've got LLPs, you could have trust, you could have other forms of entities. For them, the standards which are issued by ICI, they will apply. Now, to my knowledge, at least, there is no difference between the standards issued by MCA, accounting standards, and those issued by ICI. So there are similar. And within each set, be it accounting standard issued by MCA or be it the ICI, then there are some set of relaxations or exemptions for smaller companies. So you've got level 1, level 2, level 3. So you've got those exemptions there. But I won't get into, I think this is very pretty basic. People would be aware. But I just want to reiterate, if you're not a company, do not think those standards don't apply. You still have accounting standards issued by ICI. They need to be adhered to.
Thank you.
I just wanted to add one point. We have seen in peer review board, we have seen in financial reporting review board, quality review board, that we are sometimes, what Archana ji said, sometimes we are, without seeing, without looking at which accounting standards are applicable in the notes to accounts with the applicability of the accounting standards, we have seen in certain listed companies also where it has been mentioned that the company is complying with the accounting standard issued by ICI. One has to be very, very careful which accounting standards. It is now not the company's accounting standard rules for the company's accounting standard rules 2006. It is 2021. So smaller things, but of course, what happens that later on when any regulator or investigator looks into that and he sees that, okay, this is not AS compliant. So kindly take care of that. Thank you.
That's my next question to you, Praveen sir. What are the formats in which financial statements are required to be prepared? And would these formats are different for interim and limited review statements? And also, I will combine another question also, like who is responsible for preparation of this financial statement and notes on accounts?
Yeah, I'll answer the second question first. Many times, when you speak with the people, the clients, they assume that, this is, so I am running a small business and I have, this auditor is helping me. So they assume that it is responsibility of the auditors to prepare these financial statements, whereas it is very clearly defined everywhere, not only in the Companies Act, but also in other literature, as well as the audit reports which we are signing under SS 700, 701, whichever standard on auditing we are signing, we are clearly mentioning that it is responsibility of the management to prepare the financial statement. This is one area where it is very critical to be clear that who is the owner of financial statements. So it is the management. It is the people who are running the business. The role of auditor is to give an opinion on those financial statements in form of a report which is being issued. So one has to be very clear, and there is a discussion going on whether the auditors are required to sign on the balance sheet or not. Because ultimately the balance sheets and statement of financial statements, they are prepared by the client or the business person, and they sign on the financial statements. Auditors are preparing the audit reports, so they should be signing only on the auditor's report. That's a debate going on here in some corners. But it's very clear that it's not the responsibility of auditors to prepare the financial statements. Now, financial statements. So when you read Section 129, read with the Section 133 of the Companies Act. So I'll quote some extracts from there. The financial statements under Section 129 of the Companies Act 2013. These financial statements shall give a true and fair view of the state of affairs of the companies, comply with the accounting standards notified under Section 133, and shall be in form or forms as may be provided for different class or classes of companies in Schedule 3 of the Companies Act 2013. Now, this is for the companies. However, this section doesn't stop there. It says that provided that the items contained in such financial statement shall be in accordance with the accounting standards. So there are formats which are given in the accounting standards also. Also, this very section conveys that provided also that the financial statements shall not be treated as not disclosing a true and fair view of the state of affairs of a company merely by the reasons of the fact that they are not disclosing. So there are companies which are insurance companies, there are companies which are banking companies, there are companies which are in the business of generating supply of electricity. So they have to comply with their own regulations. And these regulations also define the formats of financial statements. So you need to be well aware that there are regulators who are defining the formats of these financial statements. So in the company law, there is Schedule 3. Then in case of banking, there is the Banking Regulation Act. In case of insurance, there is Insurance Act. Then there are other regulators also, and also SEBI also provides you some directions and some formats in which you need to report to them. So you need to be careful which is the entity and for which purpose you are preparing these financial statements. Also, please remember that when you are making a consolidated financial statements, you also have to ensure that there might be a requirement of the consolidating entity to get the information in a particular format. And also then, so I can go on and on these formats, but I remember when we were many years old, we used to prepare T-shape. So please, T-shape format is not being used by anyone. Although when you look at some of the literature or the basic accounting books, which are being discussed in schools and colleges. So in order to make it, make it understandable for the students, they talk about assets on this side and liabilities on this side, but that format is not being used as of now. Pramodji, would you like to add to this? Because this is something which is very basic, but I think in some corners of our country, I think this is area which is a matter of concern.
Just to add, Praveen sir, just one point. Basically, when we say Schedule 3, which has got three divisions, Division 1, 2, and 3. So one is for non-Ind AS companies, and Division 2 is for Ind AS companies, and Division 3 is for NBFCs who are following Ind AS.
Yes.
However, for the proprietorship partnerships, LLPs, the formats have been prescribed by your own institute, the Institute of Chartered Accountants of India. So you have to follow those formats. Even for the not-for-profit organization, NPOs, the formats have been brought in by your own institute. So you have to follow those formats. And one very important point which Praveen just started with, that the primary responsibility of preparation of the financial statement is of the management. However, we have seen again in various listed or unlisted companies that when we go through the notes to the accounts, we see the language in such a way that it is not of the management but the auditors. So the wordings, the language has to be that of the management. Kindly take note of that. I will not go beyond that, but yes, very, very important to take care of that. It's sometimes what happens that we feel that whatever is to be said by the auditor, we put that into the notes to accounts. No. For the auditor, as rightly said earlier, it has to be the auditor report, financial statement, management. So please take care of that.
Sir, can you please also clarify, like for non-corporate entities, the format which has been prescribed in our guidance note, is it mandatory or recommendatory?
Asha ji, very, very simple thing. You prepare a rule for yourself and then you ask whether it is mandatory or voluntary. घर में rule बनाने के बाद voluntary optional नहीं पूछना चाहिए. It is your own institute.
Many a times, this is the question which we face in our seminars also.
You ask, you just tell it is your own institute's formats, and it is through guidance notes now, and guidance notes are mandatory in nature. And of course, it is for the standardization of the formats throughout the country. You know, we have been saying CA chartered accountants are partner in nation building. Absolutely. But then when there is a standardization, there has to be a standardization. Who will bring along? Who will bring that standardization? Chartered Accountants Institute. So for that is the process. So we should all help that in achieving that process. Okay. It is for the benefit of the assessee.
I'll be very curious.
Yes, ma'am.
Sorry. If I can just add, I was just saying, I'll be very curious. Why would anyone not want to follow the ICI format? I mean, why would they think that is not right? And what, as an individual, I'm just wondering, what would be the reason to say, I mean, if everybody started doing this, I don't like this, I will follow my own gap. I don't know where we land, but I'm quite curious. Why would you say, I don't want to follow what institute has given?
No, Archana, what happens actually, you're very right. You're very right. What happens actually?
Why would someone want to?
Actually, because some of the persons, they don't want that change. So
I get it. I'm just saying some of them mandatory, etc. I would just say, like you just correctly said, it's your this thing after issuing this, think about it. It's your how. I'm just adding to that. The way once something had come from ICI, I would be very wary of deviating from it. I mean, it has the stamp all said and done, whichever form of the regulator, and so much of thought would have gone into it. Can I, sir, I know we were supposed to go on to the next one, but since some of the points which have just triggered, can I just add, sir, to that?
Yeah, 100%. Sure.
So I know right now the focus is on year end, but since the question was also on interim financial statement standard, can you hear me?
Yeah.
So you have the standard provides you, be it AS or Ind AS, both provide you a condensed financial statements and a full. So interim can be prepared two ways. Now, usually interim is prepared for the purpose of by listed entities for the purpose of your LODR requirements. There can be various ways. Companies can just prepare financial results okay, not interim financial statements. So you can prepare financial statements and then extract financial results out of it. There, I just want to, we've seen various practices and they're all right. I mean, you can meet the requirement in the same way. Some companies voluntarily will do a full scope, financial statements, just like they do at year end. They will prepare the interim and they publish it also. And then you prepare financial results basis that. In that case, it's like, it's like true and fair in that sense. The other is, like I said, I can do condensed. And when I do condensed, there are two ways. One is I do condensed together with Schedule 3 disclosures, or I do condensed without Schedule 3 disclosures. So I'm digressing a bit to say that if you are not fully complying with Ind AS 34 or AS 25 and not giving all required disclosures, then if it's just being done voluntarily or it's just being done for management purposes from where you will extract financial results, then please see whether it becomes special purpose framework. So from a reporting, the framework, is it a general purpose framework or is it a special purpose framework? If you're not fully complying, you actually have to be, you just can't just decide I will not. So if you decide not to have certain disclosures, you need to see whether the framework being followed is appropriate. So if I'm doing it, let's say for the purpose of preparing financial results, I can do condensed. I feel it will still be appropriate. And I can do condensed without Schedule 3 disclosure. So their interim is a bit of, we've seen multiple kind of, the varieties, if you can use that word, just be very careful to make sure what framework you're following. Your account basis of preparation should highlight that, especially if you're going to put it on your website or not put it, or if you're going to share it with others. But yeah, just wanted to highlight on the interim.
No, that thing, one thing more out here, Archana ji and Praveen ji. It is not only about listed companies. Let me take a very simple, a company to which accounting standard is applicable. They might require the financial statement for the purpose of buyback.
Yeah.
They might require it for the purpose of banking loans.
With many purposes, many
purposes. So what we can take from this, that they should follow the same system which they are doing for the annual accounts, apart from the regulatory disclosures which are required as per Schedule 3. Regulatory disclosures, apart from that, all the accounting standards under that should be compliant with. Is that fine? Now suppose the company is to first time apply the Ind AS. First time up to apply the Ind AS in for say March 24. So they have to apply for the first time in March 24. So in interim, they have to prepare a financial statement, say, for the purpose of buyback of shares. So should they follow Ind AS or AS is also fine? So because those financial statements are required to be prepared there.
Should I add? It's a very interesting bit that you raised. So let's say if I'm a company which will move to Ind AS my first Ind AS year is March 24. So if I'm preparing anything interim, I would actually say it should be on Ind AS. Now, what actually also happens is very interesting. I'm sorry, I'm going to take time. Let's say my first Ind AS financial year is March 24. And I also have a scheme, okay, in let's say April 23 or May 23, I'm filing a scheme of merger. I've seen companies even putting reference to AS. I think when you know by the time something is being filed, you know for the year end, the policies will be based on Ind AS. I would suggest it is advisable. I'm not going to get into legally, can you defend or not, but interim, definitely Ind AS. But if you're doing something like any other legal schemes, etc., then even there, I would actually suggest the right basis would be to do the accounting using what is going to be applicable to you at the end of the year. That would ensure consistency. See, ultimately, at the end of the year, it shouldn't be a surprise for the shareholder. The whole purpose of interim is you kept on getting information, and usually you will expect your year to be some total of Q1, Q2, Q3, Q4, or whatever it is, half year, whatever. Now imagine you kept on giving some information and suddenly at year end you turn it around and say, these are not the numbers. So that defeats. The purpose is to have consistent policies that you expect to follow at the end of the year.
So shall I proceed with the next question? Yes.
Yeah.
So Ashna ma'am, my question to you regarding this PPE, as the year end approaches, what are the points to be considered for recognition of property, plant and equipment? And in addition to the general points, we will also request you to explain for the assets under construction, like till when would it be considered or remain as capital WIP, and when it should be recognized as PPE for this commencement of depreciation and all.
Okay. See,
Archana ji, just to, why this question is again important, because under section 115 VAP, after the Income Tax Act, a company has to commence manufacturing by 31st March 24.
yeah.
So if they don't commence, they won't get that benefit. So unless that PP is there, that production is there, that the issue would be there. So when they can capitalize, when they not. Hence, for all participants, her answer would be very, very important, that when you can do, when you cannot do.
Okay. So one is, I have one very small request. I think quite often, while it's easier for me to say, but practically there could be challenge. Yes, I understand tax considerations do matter, but I would do it in 2 steps. First, please do what is right as per accounting. Do not get so overawed by what tax would be. Yes, if you come to a very odd situation and you feel, it is just not stacking up right logically, not just because it is not favorable. Don't go by, is it favorable or not? Just see, is it making, if it is not stacking up, then maybe you kind of consider. But I would say that these are 2 separate acts. If the outcome in income tax and if the outcome in accounting standards was to be the same, you'll never have any adjustment. There would be no deferred tax, right? The reason there is a deferred tax is because the 2 can be different. So I'm going to answer from the perspective of accounting. And Asha, if you don't mind, because the question is to say what are the considerations for PP, there can be multiple. So what I'm going to do is, rather than keep it very vague or broad, I'm going to focus on the bit that you asked about work in progress, right?
Sure.
Now, this is very, very important. And the reason it is also, in fact, you will see this principle that I'm going to talk about is the same in AS Indias. Don't get so carried away by the jargons which may be there. The concept is the same. The whole thing is about, is the asset, if something is being constructed, is the asset ready? And I'm not using the exact words, but it just says, is it available for use in the sense it was intended? That is the key. Now, I'll explain this principle through 1 or 2 very simple examples. Now, why does this cutoff become important? One could be the income tax or whatever, but quite often we've seen companies may not want to capitalize and continue to put it in CWIP, because till the time it is in CWIP, you can also capitalize your borrowing cost. So this that has the asset, is the asset really ready? Because 1, it could impact the borrowing cost. It also impact the depreciation, right? If you delay the capitalization time, you're also obviously not recognizing depreciation. Now, when I say the asset is ready for use or is available for use in its as intended, what does this really mean? And now let me take one simple example. Let's say that I wanted to construct a school building. I said, okay, I'll have classes from standard 1 to standard 10. Now each floor was going to have 1 class. Now 5 floors are ready. I'm conducting classes from class 1 to class 5. However, my floors from 6 to 10 are not ready. I'm not doing classes from 6 to 10. Now to say, listen, I always intended to operate a school which had 10 classes, 10 when I say classes in the sense 10 standards. And because I'm only operating for 5 standards, it's not ready as intended. That cannot be. That cannot be the criteria. The fact is, if it's partial completion also, you start recognizing the fact that 5 floors are ready, you're running 5 standards there. Even if it's partially completed, you capitalize partly, right? Let me take another example. Let's say if I say that, I'm constructing a hotel. Right now, my rooms are ready. I've started renting out the rooms. But, I always thought I'll also have a banquet hall. I'll have this facility. I'll have, et cetera, et cetera. All those are not ready. And therefore, right now, I'm only charging lesser rental than what I would have charged if all these facilities were available. Now, the fact that you've started operating in a partial manner with lesser facilities means you're still able to operate. It is capable of generating revenue. right? You can't say, oh, I expected occupancy to be 80% right now, occupancy is only 60%, but you're continuing to operate, right? So that is when you should, when it is capable, which means it is able to generate revenue, you stop capitalization. Okay, that's the key point. Now, they cannot be, nobody can give you a very prescriptive rule. Like I said, you just see, is it being. Again, what happens is that quite often companies will say, let's say, let me move away from a hotel or a school. Let's say I'm setting up a production line. Okay. And they say, oh, my production line is generating products. I'm producing goods, but it is not as per the quality that I wanted. I wanted X quality. This is inferior quality. Now, just think about it. Truly, if it was a trial run and you were not happy with that quality, you'll do one batch, you'll stop, you'll tweak, then you'll make. But if you, let's say, it is operating or it is giving you a product at a quality lower than that you envisage, but you're continuously doing that, that has actually become your normal. So you are, let's say, for the past 6 months, 8 months, you're just manufacturing that level quality, that level of quality goods, and you're selling. You still can't say I'm still in a CWIP stage. So trial run only if it is genuine. Like I said, it cannot be such an extended trial run that you can say, oh, I'm doing my trial run for 5 years. That can't be, right? So you need to be very careful. There could be certain minor, small administrative tasks left. I wouldn't postpone capitalization for that. Now, this principle, like I said, applies in AS and Ind AS. Now, why did I also refer to a carve out in Ind AS? Now, what happens is that when something is under the construction stage, let's say you also doing trial run production. So the question is, what do you do with the expenses that you're incurring on trial run and the revenue that you get from that sale of that trial run product? Now, earlier, what was happening is anything which is during trial run, you will net it off and that would go into your capitalization amount. So let's say you incurred a trial run expense of 100. Of course, if it is not of the right quality, what you're generating, you would, let's say, you expect maybe scrap value, maybe 20, 30, whatever. The net is your net expenditure on trial run, which you will capitalize. Now, what was actually seen, like I said, companies were not really capitalizing, and, the revenue which was being earned, which was actually the proper revenue, not really a trial run revenue, was still getting adjusted in the cost to be capitalized. And therefore, now what the international standards have done is they've said that trial run would go through profit and loss. But we've kind of stayed put because we feel the challenge was actually, it is not conceptually incorrect to capitalize trial run expenditure. I think the issue is more about the cutoff not being properly determined. And that is where we've seen a challenge, not just in India, but even globally.
Very well explained, ma'am. Another linked question is, can you hear me?
Yeah.
Another linked question is related to recognition of intangible assets. You would like to share your views on this?
No, the concept will be the same in terms of capitalization. The capitalization principles would be the same as PP.
Okay.
So when it is CWIP, whether it is a work in progress of tangible or whether it's a work in progress of intangible, the outcome would not, the concept is still the same.
And if an entity is following revaluation model, then when to revalue and who to revalue, if you can touch upon this.
Yeah. So in terms of revaluation, AS is quite, okay, I think principles are now largely aligned. One is you can't just cherry pick and say, I will do cherry picking of, revaluation in the sense, let's say I have 3 pieces of land, I will only revalue one land and not the other 2. But yes, you can do revaluation of a class of assets. So you can decide you will revalue land, but not maybe, let's say, your PPE, in that sense. But once you come to revaluation, the model is that it doesn't say that you need to necessarily revalue every year, but it says that you need to make sure that the revaluation is happening at such periodicity that it is reflective of the fair value in that sense. So unless and until you can really demonstrate that nothing has moved, you need not. But at any point of time, under the revaluation model, it is expected that revaluation, the revalued amount would be representative of the fair value in that sense, and that decides your periodicity. Then there are extended requirements in terms of where should revaluation reserve go? What do you do when you sell it? I'm not going to get into that unless until somebody requires that. We've not frankly seen revaluation being used very frequently. At least in my personal experience, I've not seen many companies using it.
Now coming to you, Praveen sir. Next question is related to this impairment. I want to know what steps required to be taken during the finalization of financial statement to ensure accurate valuation of assets and recognition of impairment losses. And another linked question with this is regarding impairment testing requirement for assets under Ind AS 36. Means what are the implications on financial statements, like how the finalization process will address this issue of testing. Your views, sir.
Yeah, so basically, once you look at Ind AS 36, it clearly says that an impairment is recognized, impairment loss is recognized when the carrying amount of an asset, it exceeds its recoverable amount. So there are triggers which indicates that there is a requirement of impairment testing. And if it comes out that the carrying amount is more and recoverable amount is less, then you will need to book that impairment loss. So this impairment loss is the difference between carrying amount and a recoverable amount. And please remember that recoverable amount is not the fair value. So basically fair value less cost to sell or its value in use is the recoverable amount. So this standard, it requires regular assessment of assets for indication of impairment and the reversal of impairment losses when such conditions are met or any indication that the asset has been impaired, except intangible assets which are not amortized. In this case, testing could be done annually. Now, this standard also gives you guidance that the loss is recognized through P&L and it is calculated as the difference between carrying amount and the recoverable amount. Now, coming to your question, it is important to note that these specific calculations and considerations for impairment may vary depending on the nature of assets and the applicable accounting standards, which is Ind AS 36. So the estimate of fair value and value in use may require professional judgment. And this is one area where, as an auditor, you are supposed to look at the estimates which were done in order to arrive at that value. So let us say the company or the entity has used an external expert to get the fair valuation done. As an auditor, you cannot just receive a piece of paper and which says that the fair valuation is done and you feel comfortable that this is fine. You need to also understand how this fair value was arrived at. What were the estimates which were used in carrying out this fair valuation? And now, if you look at some of the recent orders of NAFRA, they also amplify requirements of the auditing standards, where the auditors are required to look at the work of experts from a professional skepticism point of view. They need to understand, what is the capacity and capability of these people who have done this, and also the detailing in which they had gone. And also the auditor, because this is a very subjective issue. And trust me, impairment testing in any large organization because it has got a direct impact on the bottom line. The companies and the auditors, they are very, very sensitive towards it. They should be very sensitive. The auditor should be very sensitive that whether impairment testing is required, and if required, then if there is a impairment loss coming out of it. So there are considerations which are which as an auditor you need to be very, very careful about, and you need to prepare your audit work papers that you actually looked into these areas, you actually looked into these estimates, and you challenged them, and the answers which you got were enough for you to get convinced that this particular loss which is being booked is true and fair. And if testing is done and there is no loss, then also you need to understand how they have arrived at this particular situation. So this area is very, very sensitive, and I recommend that you go through the standards very carefully and also look at audit work papers related to looking at reviewing the work of an expert in that manner. Yeah.
Thank you, sir. Now, Archana ma'am, coming to the accounting policies and accounting estimates. Archana ma'am, are you there?
Yeah, please come.
Okay.
Just for the network, I've switched off my...
Yeah, I can understand, ma'am. नेटवर्क और ये वर्चुअल में कुछ फायदे हैं तो कुछ नुकसान भी कभी-कभी हो जाते हैं, तो that's perfectly fine. Now our next question is relating to this accounting policies and accounting estimate. How do we differentiate between a change in accounting policies and a change in accounting estimate as far as the process of finalization is concerned? And another question linked with this is regarding the concept of retrospective restatement as it pertains to the Ind AS 8. Like if a company opts to change its accounting policy retrospectively due to certain modifications in the other Ind AS requirements, so is it necessary for the entity to prepare a third balance sheet in accordance with the Ind AS 1?
So I'm going to take these as two separate ones.
Yeah,
First,
sure.
I like spend a little time because while it is a basic one, it's a very conceptual one, and there is this, for very good reasons, there is still confusion in terms of change in an accounting policy and accounting estimate. It continues to be an issue which I think is still requires clarity. Now, I'm going to take the benefit, if you don't mind, of some recent, there is a change which has now come up in Ind AS, which will apply for the financial year March 24. I'm starting with Ind AS and I'm aware of the concern that people will have on AS, but trust me, this change in Ind AS which is coming is clarificatory. Okay, it is not like a sea change or conceptual change. It is clarificatory, which will help us better understand. And if you can use this, while the same changes have not been mapped into AS, the outcome should be the same. That's the way I look at it. It's just that maybe the concept is now better elaborated in Ind AS. So I don't expect a different outcome, but I'm going to use Ind AS for the purpose of explaining, right? Now, this issue of what is a change in accounting policy and estimate, like I said, continues to be an issue which generally everybody was encountering. So very recently, IASB also picked it up. And actually, the reason this also was a bit confusing is when you look at the standards define what is, the standards define what is an accounting policy. It doesn't define change in accounting policy, but when you come to accounting estimates, it's the other way around. It doesn't define accounting estimates, it defines change in accounting estimates. So I'll repeat. If you see the standards, there is a definition of accounting policy, then you have a definition of change in accounting estimate. So can you see there is a bit of a mismatch? Without defining accounting estimate, you define what is a change in accounting estimate. And that is where I think when the standard was being applied, there was lack of clarity, and it kind of obscured the distinction between the two. Now, the Ind AS amendments, which are, like I said, are applicable for the current year, will help companies distinguish between the two. Now, what have they done? The first is that the first thing which has been done now is that in India 8, okay, they have brought in a definition of accounting estimate. Okay. So the accounting estimate is defined as monetary amounts in financial statements that are subject to measurement uncertainty. So just focus on the word measurement uncertainty, which means estimate is something which will inherently have measurement uncertainty. Now, think about an accounting policy. I'll tell you how the two interact. When you look at an accounting policy, the accounting policy itself may require an item in the financial statement to be measured in a way that involves measurement uncertainty. So let's say my policy is to recognize something at fair value. Now that measurement of fair value will involve uncertainty. Okay. So just to repeat, accounting policy may require the item to be measured at a monetary amount which you cannot directly observe, which needs to be estimated. And therefore, the entity will develop an accounting estimate to meet the objective of the accounting policy. So when you look at an accounting estimate, when you develop an accounting estimates, you will generally see that it involves use of judgment. There will be use of assumptions. So if I was to typically see, in terms of estimates, what we call, you have measurement techniques. Okay. When I say, for example, you are using the loss allowance, measurement technique for expected credit losses, or you could have valuation techniques, like I just said, for measuring the fair value of an asset and liability. Now, I'm going to add to the confusion a little bit more. Okay. The term estimate itself is used widely. Okay. It at times is also used for items which are other than accounting estimates. So let me put it like this. Just think about cash flow. The fair value is an accounting estimate I'm going to make. And let's say I do it by virtue of cash flows. When I'm preparing my cash flows, I need an estimate of, let's say, how the estimate of growth. Now that growth, the percent, that is an input. When I say, okay, my revenue will grow by 5%, that is not an accounting estimate. That is an input. My estimate is the fair value and my policy is the other way. So that's how it works. So some of the inputs when you are using for applying the measurement technique in the one I took was the expected cash outflow. The input was like, let's say the growth rate, etc. That was the input. My measurement was expected cash outflows. My expected cash flows for the purpose of determining the fair value. So in India, what they have now done is to kind of address this confusion. They have taken away the definition of change in accounting estimate. They have brought in, like I said, the definition of accounting estimate itself. However, it's not that the concept of change in accounting estimate has gone. That is still there. Now, the standard also has kind of clarified that a change in accounting estimates that results from a new information or a new development is not correction of an error. So let's say you made an estimate of, your sales return, and the actual outcome can be different. So if that actual outcome is because of some new development, it is not an error. But of course, if that information existed, but you had ignored it, then it would be an error. Similarly, the effect of any change in an input or a measurement technique, which you use to measure an accounting estimate, there are also changes in accounting estimates if they don't result from error. As far as the definition of accounting policy is concerned, that remains unchanged. Let me just I know it may just seem like a lot of jargon, which I just said, but let me just explain by a simple example. Let's say I have to determine if I look at investment property, for example, the fact that I will measure my investment property at fair value, that's my accounting policy. What is my accounting estimate? Let's come to that. Now, let's say the fair value, I can determine fair value in various ways. IFRS 13 or India's 113 says you can use an income approach or a market-based approach. That is my estimation technique, measurement technique. Okay. So if I move, I'm still on fair value. My accounting policy is fair value, but I want to move from income approach to market approach. that will become change in estimate. Okay. Are you with me? And
Yes.
let me take another example. If I have a share-based payment, I have a cash-settled share-based payment liability. My accounting policy is that my cash-settled share-based payment liability has to be measured at fair value. This is my policy. How I measure my fair value will be the next bit. Now, let's say I'm measuring my fair value as per the standard. And one of the inputs, when I'm using Black-Scholes model, let's say, sorry, I said I'm going, one of my inputs is in the Black-Scholes model is, let's say, the volatility of share price. That is changing. So that is a change in estimate. Okay. So if you can see, they both work together. You will have a policy. Policy may itself require the use of a estimate, and how you measure the estimate, if that is changing, not because of an error, but because of new information or new development, then the change in estimate is the change in accounting estimate itself.
And also useful life of assets.
Yeah.
Yes.
Okay. Maybe let me clarify. Yeah. So I think it's, so this bit is common. I think when we look at, I think that has also now changed. Yeah. But just to clarify, because you're absolutely right, that there is this tendency to think whether the change in the depreciation, see, change in useful life is clearly a change in estimate. But earlier what used to happen is change in depreciation policy used to be, depreciation method used to be considered as a change in accounting policy. That is not the case. So if I'm moving it as rule, when you are, don't try and mug it up. Okay, now this is a change in rule. This was earlier. This is a change in estimate. Earlier it was a policy. Think why? Because if I was using, let's say, SLM, okay, I made an estimate. Let's say my asset had a useful life of 10 years. And I said, I'm going to use SLM, which means my estimate was that the asset will be consumed equally. What is depreciation? Depreciation is a measure of how you will consume the asset. I estimated my consumption will be equal. But my actual experience shows that no, my consumption is more in the initial years. Then I realized that actually WDV. So when you are moving from WDV to SLM or SLM to WDV, you are changing your estimate of how the asset is going to be consumed, right? And that is why it is a change in estimate.
But earlier, Archana, the accounting standard was very clearly, it was in clause number 16, if I remember it correctly, in accounting standard, erstwhile 6. It was clearly mentioning that change in depreciation method will be change in accounting policy.
Yeah. Yeah, but like I said, now
the situation has
I think when we move to India, that's where, yeah.
Yeah, even for the entities who are applying AS, they will also go with the same because there's a definition there and there is a guidance there in the INDAS.
Yeah. And sorry, if I can just to make sure there is no confusion, in the previous question when you had asked Asha about revaluation, I just want to reiterate what we discussed was revaluation more in the context of PPE, tangible asset. In intangible, because you had raised a question on intangible and CWIP, but on revaluation, the concepts are different. On CWIP, the concepts are somewhat similar, though it may not be that easy to apply for intangible. But when you look at revaluation, if you look at AS 26, AS 26 does not permit revaluation. And under INDAS, even though, yes, revaluation is there, it is subject to certain very stringent conditions that you need to have active market and so on. So quite often you will see that the criteria for revaluation basis is not met for intangible. Okay, so I thought I'll just clarify that what we had discussed was more in the context of people.
That's very beautifully explained with the help of example. So now, Praveen sir, my next question to you regarding this non-adjusting event. And before that, we are already half past our. Yes, ma'am, you want.
And so sorry, Asha, I missed on, but let's go to let's deal with the question Praveen has. I'll come back to the retrospective restatement for change in policy. I'll come back later. But
Okay.
let's just move to I'll come back.
Okay, ma'am. So, sir, regarding this non-adjusting event, is the company mandated to disclose any non-adjusting event occurring after the reporting period but before the signing of balance sheet in the notes to accounts?
So this is also one of the very important and very practical challenge. When I mentioned in the beginning that you have asked, you have put up very interesting and very practical questions. So when you go to small and medium practitioners, practicing units, you find that this question keeps on coming again and again. So something happened after 31st March, but before the finalization of financial statement, before the signing of the audit report. So concept of subsequent event, so IFRS is very clear about it, and Ind AS is also very clear about it, that events after the reporting period contains requirement for when the events after the end of reporting period should be adjusted in the financial statements. And adjusting events are those providing evidence of conditions existing at the end of reporting period. So non-adjusting events are indicative or conditions arising after the reporting period. So you have to categorize, adjusting events, non-adjusting events, and where the disclosure is required to be made, and where even disclosure is also not required to be made. So, for example, one of the questions which we were debating, whether there is somebody has challenged the law, let's say, for example, GST or something in the court of law, whether that will have an impact or whether that will be a subsequent event. So you need to be very careful which are the items which are going to hit your financial statements on 31st March, and there are evidences, that these are going to be adjusting events. So I think this is one area where you will need whole 2 hours to have a discussion around subsequent events, because this is something which is very, very subjective. But basically, you need to draw your guidance from the standards, and it's very clearly saying that there are adjusting events, which are they are those where the evidence of conditions existing at the end of reporting period. So you need to have focus on evidence, and the non-adjusting also. But non-adjusting, you will have to make a disclosure. But then there are certain items. So you also need to look at the framework where the concept of materiality has been defined. So you also have to test these events on the test of materiality, whether they will have such kind of impact. And then maybe we will discuss about significant and material, and all those kind of concepts will be there. But for the time being, you need to be very careful about identifying, and especially in case I want to give an example, it's about the contingent liabilities are the areas where you have to identify whether the provisioning is required to be made, whether the disclosure is required to be made, or whether nothing is required to be done. But you have to make a note of it, and you have to have your audit work papers around that. Archana, would you like to add to this? Yeah.
This is again one of my favorite, one of the areas I love to talk about. So if you don't mind my adding, but sorry, Asha, you've left me with just thinking so much more and more about the other aspects also. So just for the participants, PP, I know I'm just going back. PP has many more aspects which we are not discussing. There's a concept of enabling asset, there's a concept of component and all those things. We're not discussing all of those. We just discussed a little bit. Coming to, adjusting, I think one is, while I just wanted to add that accounting standard has a concept of adjusting, and very surprisingly, auditing standard also has a concept of adjusting. I'm going to share, like Mr. Praveen said in the beginning, purely my personal views. What I may say, many may kind of disagree with, but I still want to take the opportunity of sharing it. When you look at accounting standards, the accounting standards term the subsequent events as the events which happen between the reporting period, which is the end of your year, and the date the financial statements are approved. Okay. So typically, there is a tendency to say, okay, beyond the board of directors, once the board of directors adopt the financial statement, I'm going to do nothing. Okay, that's my closing point. But is that so? I'll just request you to think about two things. One is that under law, at least I'm talking about companies, I'm not talking about others. Under Companies Act, nothing stops the company from revising financial statements till the time they are approved. And if you revise them during board meeting and the approval date, the shareholder date, these are not termed as revised financial statements. See, legally, board is supposed to approve and then give it to the auditor for auditing. But practically what happens is you complete the audit and then you sign off. So technically, I can easily say this financial statements which have been given to me by the board, these are now available to me. Yes, I've signed it the same date. But does that stop the company from revising? My understanding under law is that it doesn't. Now, why am I sharing that? Is when you go to SA 260, SA 260 actually takes it further. SA 260 says, if there is nothing in law which stops you from revising, then it requires you to revise even after the board date. Now, when this standard came, there was a lot of reaction to say, how can an auditing standard tell us anything about accounting? But think about the objective. And it's not that they are saying you start adjusting for small things. That is not the objective of SA 260. Once the board has approved, they're saying, let's say if something very significant comes to your attention that causes you to believe that, let's say board approved the financial statements in June, your shareholder meeting is in August. And if by the time you're going to place it to the shareholder, these are not really the numbers that they should be basing their decisions on. Is it really the right thing to give them those numbers? A very simple example is, let's say, I'm going to take what Mr. Praveen said, a major liability got crystallized. Let's say it takes, I was super confident that nothing will happen, but I lost the case and it hits my revenue line item is big, but my profit line item is thin. And let's say, takes away 50% of my profit. Would it really be right? Okay. So it is not saying that you start adjusting for every small thing between the board date and the shareholder date. But the way at least I read it, and is permissible, my knowledge, that if there is a big ticket item, and I'm saying big ticket as in really big ticket, not the normal course, then I would actually see how SA 260 applies. SA 260 tells you, in case it has been circulated, let's say you had signed off and the copy has been given to the bankers, then what to do? It gives you full guidance, follow that. So sorry, I just feel the reason I wanted to pitch in is I feel there is a tendency to ignore SA 260. And I'm not asking anyone to apply 260 for small things, but for big ticket things like, a litigation to this extent, or let's say, fraud is detected. Okay, just imagine a fraud is detected, or let's say there is a business merger which comes through, your court order comes through. There's some of these examples in which you should think about it. And the only exception to what Mr. Praveen said is that going concern by nature is always an adjusting item, by nature. So let's say on 31st of March 24, everything okay. On 10th of April, this example is there in the standard, not my example. There is a fire. Okay, I think it's there in the, if it's not, I think it's there in the standard. There is a fire. Now, someone can argue this condition did not exist at the balance sheet date. It's an event for which conditions were not existing. But because this impacts, let's say I only had one factory and that one factory there is a fire, it impacts my going concern. Okay, if I had 50, that's another thing. But let's say I had one factory, it impacts my going concern. It would become relevant. So going concern is always an adjusting. And I think the other bits you may want to just add is that where again, I'm now taking your perspective wherever there's been a change from the earlier things that we were used to. Dividend is no longer an adjusting item. There was a tendency that, we said if a dividend for March 24 is being declared later, very many years ago, we would accrue. Now dividend, if it is proposed and declared later, not even proposed as at the balance sheet date, then you would take it as a non-adjusting. So these are two things I just wanted to highlight here.
Thank you, ma'am. And now I can see the time also. So we
It's
are
okay.
left with,
I think that's why
we are left
I would
with,
prefer to do whatever we are doing
no,
properly.
no, ma'am, that's perfectly fine, because whatever we are discussing, that should be discussed properly. So that's the main thing. So for the remaining questions, on an average, we have less than 2 minutes a time. So wherever possible, if we can spend less time, then wherever possible, this is
Should we
up.
then skip?
नहीं, ऐसे ऐसे मत करो, ऐसे मत करो.
Should we
Whatever
do?
are the important questions, let us concentrate. कुछ रह भी जाएंगे तो कोई दिक्कत.
Then we can have another session, sir. I think that is a good idea, because I think
Yes,
the
yes,
way
yes.
the
Subject should be
discussions are
given
happening.
its due importance.
Yeah,
Yes.
because half knowledge is very dangerous.
Very
I
dangerous,
feel.
right? Right.
Half knowledge is dangerous.
Would you
Okay.
like to answer that restatement question, ma'am, right now, or like restatement?
I'll try and be quick on that. And I think the reason I wanted to pick up restatement is also quite often, for some reason, while it's been so many years since we've moved into Ind AS, I still hear this question very often in terms of how does it stack up with the Companies Act. So one is, as far as AS, I'll come first to AS. Under AS, there is no concept of restatement of prior period. If you've got any change in accounting policy, any change in any error, everything is adjusted in your current period. So you don't touch your previous year, right? And if I may take the opportunity of just making a small request, we've seen quite often, they will do regrouping very liberally. Last year ka regrouping done very, like, it's like large scale regrouping. Oh, they were small. Now, if they're immaterial, please don't touch them. If you're saying that reclassify, if it is because the nature has changed, let's say for whatever reason, I'm just trying to think of that maybe the classification of an expense changed for me for genuine reason. Okay. Let's say maybe I'm taking the balance sheet. Let's say if something I intended to use as inventory, now it is going to become my PP. Last year it was inventory, current year it is PP. So you will not change. But let's say you feel, oh, while doing the current year, you realize I made a mistake in the previous year. If you made a mistake in the previous year, doesn't mean you keep quiet. Okay. So let's see. The mistake is such that it is a measurement mistake. So you will do the catch up in the current year. Let's say I should have recognized depreciation of 100. I recognized 80. You do the balance catch up 20. You make disclosures. But let's say it's a reclassification error. The question is then what should I do? My P&L is right, but something that should have gone into admin, I have put somewhere else, right? The total is right, but there is a tendency to say, oh, we regroup, and companies will put a standard line to say previous year numbers have been regrouped wherever necessary. That's as good as restatement, which you can't do. If you see, the earlier SS 710 was more explicit actually. I would prefer that please put pro forma numbers in the notes to the accounts. You can say that this was what we had published. This is the correct one if it's a reclassification. This happens quite often, and please be wary. The reason I'm saying this, you can at times get notices from ROC because they may map it, to what was published. And if the amounts are not same, they can question. So AS, no restatement. Policy change goes through the current year. There is a catch up, and similarly, there are when you look at error is also caught up in the current year. So policy is policy catch up is in the current year, and as far as estimate is concerned, you do the catch up in the current and the future year. When I come to Ind AS, under Ind AS, restatement is an accepted, part of the framework. But you can't do restatement at your own whims and fancies. You can't say, oh, I feel this is where restatement is. Usually restatement is done where it is specified in the standard. And usually, therefore, if I go by the standard, restatement is done if there is a change in policy or there is a error. Okay, then you go back and you restate your prior period. Now, let's say if my error was only in the previous year, then there is no opening balance sheet I need because there was no impact, right? Let's say I'm doing March 24. I realize I made an error in March 23 numbers, but my March 22 were fine. Okay. Then obviously there is nothing else to be done. But let's say I made an error in my policy. Okay. And I'm correcting my policy. So I will give the correct number in the current year. I will say if I had followed the correct policy, what my income or expense would have been in the previous year. And I will give a third balance sheet, which will basically show a catch up. It is to say, had I always followed the right policy, what my opening number would have been. So that's when you give a third balance sheet. Now, when you do a third balance sheet, a question comes up, do I need to give all notes that relate to a balance sheet? Because when you look at standard for PP, for, balance sheet has so many line items. So do I need to give full notes to the accounts for every item of that third balance sheet? The answer is no. You need to give only for the significant ones, more which relate to this adjustment. So you will not have the full set of disclosures for the third balance sheet. So yeah, I think this is a big change as far as framework is concerned. As far as IFRS and Ind AS is concerned, these are the areas where it is converged that you give a third balance sheet. Or not third balance sheet, you do a restatement with the third balance sheet. The only additional bit in Ind AS where we've added restatement is Appendix C, common control business combination. You don't need the third balance sheet there, but if you've got a common control business combination, then you will restate your comparative number without the third balance sheet. That's an additional one we've got here. So the legal issue, sorry, I know I've taken more than 2 minutes. Quite often there is a worry that people say, oh, if I'm restating, does it mean, I think it's section 131, 130, 131, 132 of revision of financial statements. They feel, is that triggered under law? So many people believe, oh, you can't do restatement because it breaches that and so on. According to me, that is not the case. I am not revising my financial statements. I'm restating my comparative. There is a difference. When I'm restating, it is only a presentation change. The amount that would have gone through my current year P&L, I'm pushing it back. I'm only presenting. My previous year financial statements, which I had submitted, let's say to ROC, to bankers, they remain valid. They are valid. But when you do revision under Companies Act, you are superseding the financial statements. The returns that you have filed, the financial statements you have filed get superseded. So there is a big difference in revision and restatement. A restatement under under Ind AS does not mean that you've triggered revision of financial statements section under Companies Act. Sorry.
Okay, ma'am. Thanks. And now next question to you, Praveen sir, regarding this employee benefit. How does the finalization of financial statement addresses the accounting treatment of employee benefits under Ind AS 19 or AS 15, including the pension, gratuity, the share-based payment?
Okay. So this topic is it's very favorite topic of Pramod ji also. Maximum number of non-compliance with the accounting standards is related to employee benefits. Maximum number of non-compliance. And whenever we, especially in non-corporate and smaller entities, so employee benefits is one standard which need to be carefully looked into. And if these are not being complied with, there has to be a qualification in the reports of auditors that this particular standard has not been complied with. The objective of the standard Ind AS 19 or AS 15 is to prescribe the accounting and disclosures of employee benefits. It requires you to recognize, a liability where employee has provided services and expense where the entity consumed the economic benefit arising from services. But this is the technical language which is being used in the standard. It talks about short-term employee benefit, long-term employee benefit, post-employment benefit, other long-term and termination benefits, all these benefits, and also actuarial gains and losses and changes in the present value of defined benefit plans. The concept is that you are, as per the framework of accounting standard, you are using an accrual system of accounting. Your employees are working in your organizations, and because of their working, after some time when they will retire or when they will leave, they will be given some benefits. Those benefits relate to this year as well. And you need to make a provision for that. You have to make a disclosure and you have to follow. And these accounting standards are giving very detailed guidance on what kind of employee benefits are required. So maybe I think Pramod ji is the best person to give more guidance on this particular aspect, because this is something which is very peculiar and it's very sensitive also, because the auditors are not realizing in many cases that this is something which is being missed out in the accounting sections.
Just very rightly said, Pravinji. Just to add, because what is rightly said by Pravinji is that we tend to miss that the service is being rendered today. Based upon that is the long-term employee benefit accruing. So all proprietorship partnership LLPs, they should provide for the gratuity and leave encashment if they are on a long-term basis. It is not that after 5 years. Many a times we go, as was said by Archana also in her initial remarks, that we go as per income tax, that it is there on the cash basis, so we'll do on the cash basis. No, when you are following accrual system of accounting, you have no option but to provide. Proprietorship, partnership, LLP, everyone. And even companies, we have seen in companies, believe me, we have seen in companies, even the listed ones and others, that they are mentioning in the accounting policy that we shall provide for the gratuity, the long-term employee benefit on payment to cash basis. It is not allowed. It is not allowed. Merely stating a policy which is not correct will not make that a correct accounting policy. Auditor will have to take care and qualify accordingly, as rightly said by Pravinji. So please care. And the only, one of the major difference between the accounting standards issued by ICI and notified by the Ministry of Corporate Affairs is for the actuarial valuation required. In case of a company, it is required in all cases, but in case of a proprietorship partnership LLP, where the accounting standards as notified by the ICI is required, there it would be only if the number of employees exceed 50. So in non-corporates, it would be employees exceeding 50, but in others, it will not be. So even if they have 10, 11, 12, they will have to get the actuarial done. So this is just what I wanted to add.
Thank you, sir. Yes.
Praveen sir, my next question to you again regarding certain penalty issues. Do we need to make any provision for the penalties which are enforceable for non-compliance of laws, including the Companies Act? We can take a case study also side by side, like relating to this company law. Archana ma'am and Praveen sir, you both can answer this. Like in case of company law, like section 185 says or prohibit any directors to give any loan to be given to the directors, but under certain specific circumstances, and any violation will attract the heavy fine and imprisonment under the company law. So in case there is any such violation made by the company during the year, does it also require for providing contingent liability or anything like that? Like, there are two things covered, like normal non-compliances and penal consequences, and a future penal consequences which may arise due to the violation of law.
So before Archana,
Why do you call it a future? Why do you call it a future penalty?
Maybe like as of now there is no penalty levied as such, but there is a provision in law, and penalty or fine can be levied at any time whenever it comes under scrutiny. Like
yeah. So I think before Archana takes on to this case study thing, I think one is the practical challenge is that there is a non-compliance and probably the business people or the person who has done non-compliance, he would or she would like to keep it under the carpet, right? So by giving a disclosure that there's a non-compliance and I want to make a penalty provision, I think they are not going to go in that direction. But when the penalty has been crystallized, because so what is required from an auditor is that they have to give an opinion. So I'm speaking from auditing perspective. Archana will take it up from accounting perspective. Auditors are required to give an opinion whether the financial statements are giving true and fair view or not. So there has been no penalty notice has been, there is no such notice, and there is no indication that such proceedings have been initiated. So if they will make a provision, then probably the auditor will ask a reverse question, that why are you trying to suppress your profit, whereas there is it's not visible that you will be penalized. So it's the reverse question which that auditor can ask. But however, in case there are proceedings which have been started already, then there is a question which will be asked, that why are you not providing for these penalties? And then maybe after listening to Archana, then I'll come back to this issue again.
So I have slightly different perspective, and my apologies. I think in the previous, and also when I was referring to auditing standard, I referred to 260, it's 560. 260 is communication with those charged with governance. Sorry. So you have got your 560, which is a subsequent event. I think this would also require us to somewhat refer to the auditing standards. Now we have a standard SA 250, which is on consideration of laws and regulation in an audit of financial statements. And you may say, oh, this is for the auditor, what about the company? But I don't think the logic is very different. It's just that if the company doesn't appropriately account for it, then I will have to report it in my report. But as part of this, it also requires you to see. So I think if I can just take the section 185 example, I like that as a base to explain the point. I would not call it future penalty. You can't wait to say, listen, I'm waiting to be caught. I will not recognize an expense till the time ROC doesn't catch me. Now, you are going to prepare financials today. You know you did not comply with. You yourself said, Asha, that my non-compliance has happened. I'm on accrual basis. The minute you do not comply, you please accrue the penalty for it. Because you'll file the financial statements, you're waiting, oh, will it come under the review? Will I get caught? I mean, you may never get caught. But accrual is to say, if you know that non-compliance has happened, you should. The interesting bit 185 is quite often I've seen companies to say, oh, I took the loan, I didn't realize it was 185 getting attracted. I have now repaid. Okay. So is it okay? Now, or the other is to say that, this is one situation. The other, which I quite often hear is, I took the loan, I didn't know, I genuinely didn't know this was 185, and presuming both genuine situations, okay? I'll just make a provision for penalty right now, okay? Both, according to me, are not right. Now, let me take the second one first, okay? Let's say I took a loan, it is still outstanding, and you're saying, okay, I'll make a provision. By that logic, if just making a provision for penalty regularized the transaction, everybody would just make a penalty and still give the loan under section 185. I'll say, okay, it's not permitted. Let me just make a provision. I mean, who cares about section 185 then? So you just can't make a provision and say, I am done. You also have to remedy the non-compliance. In case of section 185, remedying the non-compliance will mean you also repay. So not just provide, but also repay. The second scenario can be, I took it, I've repaid, and I'm saying, oh, now it is all done. No, you should still make provision for penalty. You can't, and now I'm just going more into the auditing area that Mr. Praveen said. Let's say every 1st April I take and 20th of March I repay. And so one is, of course, if it's a repeated thing, it's another thing. But I'm just saying, presuming it's a genuine interpretation error. Genuine, okay? Then, because otherwise you'll also have to look at fraud. But presuming it's a genuine interpretation, then I would still say, please make a provision for non-compliance. So 185 remedy each non-compliance. See, laws and regulation is very complex. First, interpreting it to see whether there is a non-compliance or not. Quite often, you may need the help of an expert to interpret. Okay, but I'm sorry, I'm again digressing, and I'm sorry to breach your 2 minutes, but there is a tendency to say, oh, this was a legal interpretation. I took a legal opinion and put it in the file and close it. No. Under the standard 620, this time I'm hoping I get it right? You're supposed to review the work of an expert. You need to take the responsibility. And even NEFRA has been saying that they're very unhappy about auditors just taking a legal opinion and not doing that. So first, assessing whether there is a non-compliance itself is a first step. Once you conclude there is a non-compliance, you have to make a provision for a liability. I don't even know why would I make a provision for a contingent. I mean, disclosure of contingent. If it is proven, then I will make a provision. If it is, let's say, contested, if it is contested, I've got a notice, but I believe I have not, I am in compliance. If it's a difference, then you apply your Ind AS 37 or AS 29 to see whether a provision is required or a contingent liability. So go on to that route. And then also presume that you have acknowledged that you made an error. See what remedying would mean. It could mean undoing the transaction. It could mean just making a provision. It could mean many other things. Under that law, you'll actually have to see what does the remedy mean. So that's what I just wanted to add in terms of, and this is a very, very critical area because laws and regulations are getting more complex. The regulators are looking at it very carefully. Now I think, I don't remember, but maybe Mr. Praveen would know, recently there's a new section come in for even MSME under Income Tax Act. What if you breach the MSME, you've not repaid the interest, you've not paid the interest or, settle the amount in due course. There's so many, you need to be very careful in terms of laws and regulation, which will impact. Now, the question is, there could be 100 laws which apply to a company. Question could be, or there could be an environmental law. Am I supposed to look at that? Anything which can impact the financial statements, it can lead to a provision. And I'm not talking about immaterial amounts. Then you would need to take care of that. Yeah.
Yeah, and I wanted to add on to it that as an auditor, it is your responsibility to report if it comes under the category of fraud.
Yeah.
There's a very, very clear guidance and expectations from the regulator that you will need to report it if that comes under that category and if it completes the definition of fraud. So that as an auditor, it's not only about making a provision or remediation, but if you are able to find it, and it is expected that the auditors will report that as a fraud.
Yeah. And in many cases, non-compliance can also have bearing on the directors, whether they need to vacate. I think look at dividend calculations. If you go wrong, dividend can be actually recovered from the auditor if it's improper dividend. There are many, so you need to be very careful. And you're right, so the fraud angle comes in.
Yeah, that's right.
So just as Ashna ma'am mentioned regarding that MSME law which has come in the income tax. So our next question relates to this only, to Praveen sir, regarding this MSME disclosure. Sir, there are 2-3 questions, so let me read all in one go so that you can answer it accordingly. First question is regarding disclosure of MSME dues and interest on delayed payment to MSME as per the time period specified under the MSMED Act. Second thing is, in case of corporate entity where MSME Form 1 is being filed with the MCA, but later on, at the time of finalization, we get to know that amount has been changed due to any reason, whether repo difference or something. And the third question is where any amount payable to MSME is converted into loan amount, then what disclosure should be made in the accounting policy or the notes on accounts, and whether this conversion should be made on the principal amount only or principal plus interest amount.
Yeah, and I think looking into the time and the kind of traction we are receiving from the audience, there are a lot of questions which are already being posted on the chat.
More than 1,300 participants are watching this live as of now.
Yes, I think we can take a pause after this MSME discussion, and we can take questions from the audience right there and then. And that we can, if the time permits, then we will go on to our planned questions. Otherwise, we will go to the audience questions right now itself. So first I come to the MSME portion. So every company that has obtained services or goods from an MSME supplier and has outstanding payment for more than 45 days, they must disclose it to ROC under, by filing MSME 1, as you had mentioned. And this is a half-yearly return, and that the specified companies need to be filed regarding their outstanding payment to MSME. So this is a requirement under MSME, one has to be filed with the ROC. Now, if the amounts have changed, I'm just going by the flow. So you have to report on true and whether the financial statements are giving true and fair picture or not. And in case the numbers which have changed, and if this change is material, you need to see whether the information which is going to be presented in the financial statement is giving true and fair picture or not. Whatever has been done in MSME 1 is a separate aspect. That reconciliation can be done later on. But you have to ensure that your financial statements are giving true and fair picture. And if there is a correction which is required, and then the reconciliation can be done later on with the MSME 1. So what is critical is that you are going to give opinion on that. And similarly, in case you have given, if you have converted it as a loan, and you have converted it as a principal plus interest, because as per the law, you have to mandatorily, you have to give interest to these people. So you have to make provision, make disclosure accordingly. Now I go to MSME and there is a FAQ which has been issued. And FAQ number 33, the question that what are the guidelines and, for delayed payment to the borrowers. So it very clearly says that with the enactment of this MSMED, it is like Micro, Small and Medium Enterprise Development Act 2006, for the goods and service supplied by MSME units, payments have to be made by the buyers as under. The buyer is to make payment on or before date agreed upon between him and the supplier in writing, or in case of no agreement, before the appointed day, and the agreement between the seller and buyer shall not exceed more than 45 days. Now, this is something which is very clearly defined, that 45 days is the critical period. And then your Schedule 3 also requires you to make a disclosure, and especially when you are making a disclosure of trade payable, it says that following details related to micro, small and medium enterprise shall be disclosed in the notes to accounts. A, the principal amount and the interest due thereon to be shown separately, remaining unpaid to any supplier at the end of each accounting year. And also, B, the amount of interest paid by the buyer in terms of Section 16 of MSME Act, along with the amount of payment made to the supplier beyond the appointed day. And then the amount of C, the amount of interest due and payable for the period of delay in making payment, which has been paid but beyond appointed day. So then D, the amount of interest accrued and remaining unpaid at the end of each accounting year. And then the amount of further interest remaining due and payable even in the succeeding years. So there is a very detailed guidelines which are given in Schedule 3 for making a disclosure on dues to MSME Act. And then all these terms, appointed days, buyers, enterprise, they are all defined in MSME Development Act. So basically, as an auditor or as a preparer of the financial statement, the management, they need to make disclosures in Schedule 3. And if those disclosures according to the Companies Act have not been made, the auditors will need to bring it out in their reports, auditor's report. And so this thing is very, very serious. The government and the regulators are very conscious about the fact that they need to protect MSME. And that's why recently there was an amendment which, Archana also had mentioned, that if there is a delay, then probably then the income tax will not allow that as an expense. So which became a very sensitive issue, and a lot of queries which had come to the institute also. And I think Pramodji would also like to add to this particular aspect, because MSME is something which the government is very, very particular about. The regulators are very, very particular about. The management is asked to make a disclosure, and auditors are asked to make a report whether the disclosure have been properly done or not. Of course, there are some challenges which the auditors are facing, but in spite of that, this requirement of disclosure is very, very critical. Pramod ji.
You very rightly said. Now, under the MSME, two things required for the finalization of the financial statements. Point number one, where there is a delay, either during the year or at the year end or thereafter, then the interest is payable as per Section 16 of the MSME Act. That is the 3 times the bank rate, compounded on a monthly basis, and that interest, of course, is not allowed under the Income Tax Act. That is a separate issue. But in case there is a delay, the company is required to file the Form MSME 1 also. In that case, while finalizing the financial statement, the preparers have to ensure that that interest portion has to be provided for in the books, irrespective of whether there is a waiver of the interest or the supplier is saying that I won't be charging the interest. But here at the Act, MSME Act, Section 15, it says that it overrides any other agreement or any other law. So interest is required. And in case that interest is not provided, then the auditor have to make a appropriate qualification. Second point, in case of this new Section 43BH, for arriving at the provision for income tax, kindly take care that the provision for tax is appropriately made accordingly. So the role for the finalization, the both things have to be taken care of very, very seriously. This is what I wanted to add. Thank you. Thank you.
So next question, I think before closing with our questionnaire, 1 or 2 important questions are there. We must take these also. I have a question from you, Archana ma'am. Like recently, some amendments were made regarding an exception to the initial recognition exemption in Ind AS 12. So can you tell us about that?
So I think now we won't be able to get into, but I just wanted to take 2 minutes because that itself will, without an illustration, it'd be difficult to explain. But I just want to highlight 2 or 3, if I can just take 2 minutes to highlight just 2 or 3 developments, which I would at least request participants to ensure compliance with. One is there is an amendment to Ind AS 12, wherein the initial exemption has been narrowed. So in very technical terms, if you've got temporary differences, taxable and deductible, which are equal, right? Then there is no exemption from initial recognition, right? Easier said than it's much more detailed. I'm sorry, I can't take you through it right now. Otherwise, I had an illustration which I would have preferred to have taken you through. But please just take a look at it. This is in Ind AS. This is not in AS. This is expected to impact your lease accounting. I mean, deferred taxes as far as leases are concerned, or decommissioning. These are the 2 transactions wherein this Ind AS 12 amendment will be relevant. So please do take a look at it. The second, which I just want to reiterate, is that there is also an amendment to Ind AS 1 in terms of the accounting policies. And this is not in AS, this is only in Ind AS. We earlier used to disclose significant accounting policies. Now we have to disclose material accounting policies. Many are thinking this is just a change in language, significant has become material. No, that is not the thing. How you would look at material, and therefore what is the what is also the extent of information to be given in the accounting policy. This is a big change actually. And one reason I think that probably the regulator is doing it is because right now they feel the accounting policies section itself is so large, it just goes into pages and pages, and the entire requirement of the standard is reproduced verbatim. So that doesn't really help the reader. And that is where they're trying to see how can you really give information which is relevant. So this is, please do not think about it as just a change in word. It is not. It actually, unlike Ind AS 8, wherein I said it is clarificatory, this would actually require companies to take a review of what needs to be disclosed in the policies. Now, My worry is also many will think, okay, why risk it? Just give everything just like we were doing earlier. Please also note that the standard says if material information is getting obscured by immaterial information, that is also considered to be non-compliant. So you'll have to strike a very good balance. You can't do an overload because that can obscure material information. And therefore, the extent of accounting policy disclosure would need to be looked at very carefully. I'm not going to get into that, but this is a significant one. These are two which I just wanted to reiterate. And the last is not a new amendment or something, but just a request, given the emphasis which is there on climate-related matters. Please also see whether the climate-related disclosures are being made. And when I'm talking about climate-related disclosures, I'm not talking about BRSR. I'm not talking about S1, S2. I'm saying disclosures which come because of the accounting standards itself. So let's say that, I have made a commitment of carbon footprint reduction. Now, what does that mean for my PPE? Does it mean I will have to make some changes to my production process? Does that mean I need to make any provision? Or does it mean that my current PPE needs to be impaired? Or, I will need to replace it? All those questions will need to be. Recently, IFRIC has, looked at one of the issues in terms of when to make a provision for the cost which is expected to be incurred. It's a very, very interesting IFRIC agenda decision. I think it's tentative, if I'm correct. But sorry, I don't remember whether it's finalized or tentative. My apologies. But it gets you to really understand how would you look at your commitment, whether that commitment is a contingent liability, whether it's just a commitment, not even a contingent, just like you show, commitments of fixed PP, your capital asset commitment. Is it like a commitment? Is it like a contingent liability? Is it a provision? I think that IFRIC is very interesting. But other than that, also, there could be many other standards which could impact, in terms of your climate-related either measurements or disclosure. So these are three things which I just wanted to highlight. I know these are specific to Ind AS, but AS actually climate-related could also be very much relevant for AS entities. So just wanted to reiterate and request you to pay attention to that.
Thank you, ma'am. And now, can we take questions from the audience?
Yeah, you have got only 7 minutes left.
Yes, so let's take it from there. So my question from you, Praveen sir, what are the disclosure requirements relating to purchase and donation of electoral bonds?
So it's of late, it has come into limelight because of the ruling of Supreme Court and the instruction which are being given. There's nothing new which has come. Earlier also there were donations which were given, they were disclosed. But I think it is not required to give that kind of specific disclosure, which I think the person who has asked this question, I think that kind of disclosure is not required to be made. But of course, you need to keep in mind the framework of accounting standards, which says that your financial statement should give true and fair picture. So in case there is a donation made, so it will be like come under donation, and the same kind of confidentiality will continue to be there as far as accounting literature is concerned.
Next question is regarding if any expenses is outstanding because the other party is not raising invoice for last 13 years. And every quarter the company made provisions of the expenses and till now it becomes a major amount, approx 500 crores. So how this should be incorporated in the financial statement?
I will not even try and answer this because this is just not smelling right. Who raises an invoice and doesn't collect for 13 years? Who's so charitable? How do you have these amounts? I think without really looking at the transaction, I don't want to venture into it. How 13 years? I mean, why would somebody, if these are genuine expenses, I would be very careful on this transaction. This is not a conceptual one, so I'll rather skip.
Absolutely agree with
Praveen, I don't really
Praveen sir, your views on this?
No, I think it's better if that answer should be taken as a final answer.
Pramod sir, would you like to add anything? Okay. The next
Oh, no, very rightly said by Archana ji, that one has to be very careful how to provide for such expenses.
Yes. The next question from you, Archana ma'am. For listed companies, SEBI mandates audited financial statements within 60 days. Whereas under the Companies Act, financial statement can be signed by first week of September. So can the audited financial statement approved by the board in May for SEBI compliance be revised thereafter and process the compliances for that? Basically asking for
So
revision.
my understanding is companies typically, they don't want to have these differences. So usually a listed entity, when they are doing their annual annual financial results for the SEBI purposes, they actually also close their standalone, their statutory financials. So nobody prefers to have these two separate. But let's say theoretically, if somebody wanted to, then if the financial statements are approved by the board in May and the shareholder meeting is happening in September, if there is a significant adjusting item, like I mentioned, I'll go back to SF 560, you can have a different set of answer. So I would actually, and that is exactly the reason to avoid this. Companies don't want a difference, and that is why they do the statutory closure also at that point of time. But otherwise, and again, I'm reiterating, not small changes. I'm talking about big ticket, which really makes the financial statements not give a true and fair view.
Okay. So next question, we'll skip. It has already been answered by Pramod sir regarding interest computation. Next is, what if an entity receives information of the supplier being MSME after 31st March 24 and entity has already skipped the payment on due date due to the wrong assumption, being it's non-MSME?
Yeah, I think that FAQ point number 33, which I shared with you, that was very, very clear about it. And accounting literature schedule 3 is very clear about it. You'll have to, if it has come to your notice before signing of the financial statements, you'll have to make that adjustments.
Okay.
And it will be a matter of reconciliation between MSME 1 and this particular.
Next is from you, Archana ma'am. What is the treatment of year-end provisions like audit fees with regard to, again, this question relates to MSME.
So let Mr. Praveen answer.
Disallowance, as the provision in querist opinion is not the sum payable to MSME. What are the top? Okay, this was the question regarding MSME.
Please repeat, the voice was breaking.
What is the treatment of year-end provisions like audit fees with regard to MSME disallowances?
Audit fees?
Like provision is made at the year-end, but payment is made after that audit, that after September or October of the following year.
I still didn't get. So audit fees, if you're talking, I must make a provision of audit fees. Yeah, it is required because otherwise I will not do the audit. So that's one part.
Basically, this accounting treatment webinar is going into this income tax disallowance and allowances due to this MSME provision. So
yes, I think
to...
that 43BH, Pramod sir has already mentioned about it. So one need to be careful about that. And then you also need to remember that materiality under the framework. So you will have to see what kind of materiality has been defined on that, decided by
one thing more. As regarding audit fees, of course, that will not be disallowed 43BH. But what is the difference between a provision and an expense payable? Sometimes what happens that, say, electricity expenses or certain similar water bills or certain expenses. So are these expenses payable or provisions? Because when we classify in the financial statements, we should show as per our AS and Ind AS, I would say 29, a provision or expenses payable. Is there any difference between the two?
So if I can make an attempt, there is no I mean, it's not articulated anywhere, but I'm just saying how I understand. Provision typically when I'll apply AS 29 or Ind AS 37, you would apply it for something which requires a significant level of estimation. So provision for warranties. Think about items like those. Expenses payable are your routine. You know, okay, this is what I've purchased. I had taken some services. I've not paid it. My bill hasn't come. That is not what really falls under provision. But provision is something which would require a high level of estimation, like a warranty, sales return, stuff like that.
Very right, very right. This is actually why I wanted to bring that, because many of the preparers of the financial statements put all these into provisions. These are not provisions.
In fact, if you put it into provision, then provisions also require a movement to be disclosed, how much you made.
Yes.
So those are for very different types. And if you see the definition, I don't have it in front of me right now. It says provision is something which requires a significant amount of estimation or something like that. It's clear from there itself. And these would be very big ticket items like this.
For example, you gave a warranty, then I would say a gratuity.
Sales return is also there. Sorry.
Gratuity, leave encashment, these all are
that's
provisions.
If there is a specific standard concern, then you will go there. So for gratuity, then you will go to retirement benefits and so on.
So another question from you, Archana ma'am. What are the top 3 difference between significant accounting policies and material accounting policies?
So actually it is, I don't think we can do it unless until I can make an attempt. It's not about 1 or 2, 3 differences. It's about the concept. So one is the reason why they have moved to from significant to material is because one, the term material is well understood. But the whole issue is how do you apply the concept of materiality when it comes to accounting policies? Now there, the standard has given plenty of what you call
guidance.
Guidance is, I wouldn't, it's not, maybe guidance is the right word on how to apply the concept of materiality when making decisions about accounting policy disclosures. So for example, they've said that accounting policy information which is related to immaterial transaction is immaterial, may not be disclosed. However, accounting policy information may nevertheless be material because of its nature, even though amount is immaterial. So some of them are repetitive in terms of how we understand the concept. But then there are much more, there is guidance in terms of how do you apply this. Now, if you go to Ind AS doesn't really have examples. Globally, what they have done is they've got a practice statement. So in IFRS 2 practice, the IFRS practice statement 2, they have actually illustrated how this will apply. I'll quickly take an example. Let's say that if I'm looking at my revenue recognition policy, typically what we do is we put the entire revenue recognition, or revenue is recognized when so and so, this is how allocation happens, this is performance obligation, this is how I allocate consideration, this is when timing happens. You put this long paragraph. They're asking you to really think about what needs to be disclosed. So let's say I'm a company which sells handsets and the data network. Now, there is no, let's say, significant judgment that there are 2 performance obligations. Very clear, there are 2 performance obligations. Maybe the judgment comes in that I charge a composite price to the customer, then I have to allocate it to these 2. There is a lot of judgment applied. Okay. So the standard is now in a way effectively asking you to think, do I need to put the whole thing? Now you could argue that, my policy hasn't changed. I'm not applying any choices which are there in the standard. I'm not doing any hierarchy as per Ind AS 8. Everything is normal, so I don't need to disclose anything. Here they are saying no, while everything is going as per the previous year. Because of the significant judgment applied in terms of how your transaction price is allocated to these 2 components, maybe that is what you should state in your policy. You don't need to state how performance obligations were determined. So they're saying, please see exactly where significant judgment was applied. And that is the part in this example, like I said, that you need to probably put in the accounting policy, not the entire bit. And then very, very quickly, I mean, it also gives you some examples. So they say if you're changing an accounting policy, or because there is a material change in the information, or it is permitted by Ind AS, or you've used Ind AS hierarchy, or, it is very, very difficult to really understand. Let's say it's a financial instruments kind of a issue wherein it's so complex that you can't understand without the whole thing. That is where they're saying you give, those are the areas where they really want you to concentrate rather than replicate the entire thing. So, I mean, there are one or two further examples. And like I said, companies will need to really think, for example, in the revenue recognition example I took, I may not really need to give everything. I may just need to talk about how allocation happened. So that's one way of explaining the impact of this amendment.
Okay, so with this, we will now conclude our today's session. And I will also request Pramod sir to please, if it is possible, can we have part 2 of this webinar also? Because not many queries are still there, which we could not discuss today. So,
Surely.
Okay. So with this, I thanks our learned panelists today, Archana ma'am and Praveen sir, to beautifully explaining all the things, all the questions which have been raised. And thank you so much. And now I would just hand over virtual mic to Pramod sir for further conclusion and.
No, thank you, Asha. Thank you, Asha. In fact, thanks a lot to the very learned panelists today, Praveen Kumarji and Archana Bhutaniji. Excellent deliberations. It was very lively. All the participants actually gained out of this. So thanks a lot for always contributing for the cause of the profession. In fact, we are receiving a lot of appreciation from the participants. So thanks Praveenji, Archana ji, and of course Asha ji for very, very beautifully moderating these two stalwarts, very, very rightly making the session so interactive. And also thanks to Shalini ji, Kulshekhara ji, the ASB team for organizing and all the backgrounds and the other questionnaires and others. And of course, thanks to all the participants for enriching yourself to improve the quality of the financial statements. That is very much required if we really want our country to develop to the top 3 and going to the top 1. So we all need to work upon it and keep on improving. Thanks a lot. Thank you, everyone. Thanks. Thank you.
Thank you.
Thank you so much.